Hello participants, how are you all? I hope all is fine on your side. My name is Kai Johar and I am teaching financial reporting since last 15 years here in Karachi to ACCA students and to other qualifications as well. And it's very nice and pleasure meeting you people today for a revision course named ACCA Practice to Pass. So students, I passed all my ACCA exams back in the year 2002, and since then I started working with one of the top 4 accounting firms here in Karachi, and I worked there for around 5 years, and then I came into the teaching profession as a full-time teacher. Before that, I was teaching, you can say, part-time before I started teaching this for full-time purposes. So this was a brief introduction of mine with you people. So now I will start talking about the revision session we are going to start now. We are going to have 5 sessions on consecutive days, and how I am going to conduct these sessions. So I am giving you a small briefing about that how I am going to conduct. So first of all, let me tell you that I have divided the syllabus topics into 5 days, and today's topics include financial instruments and intangible assets. It includes effect of changes in foreign exchange rates. It includes earnings per share. It includes IS 8 accounting policies, changes in accounting estimates and errors, and last but not the least will be non-current asset held for sale and discontinued operations. So these are the 6 topics we are going to cover today. Now, how I'm going to take each session and how I will teach you, let me tell you a bit about that as well. That I will brief you about the International Financial Reporting Standards main points for each IFRS, and along with it I will make you do a lot of practice questions, which include objective type questions, which includes case type questions, and it includes constructed response questions as well. So these are the 3 types of questions you will be facing in the ACCA exam. So these 3 questions types will be doing in these practice sessions. So let me tell you one more thing, that I have kept the constructed response questions for the day number 4 and day 5. So in the first 3 days, we will be doing more of the objective type questions and the case study type questions, right? So let's start today's session with IFRS 9, and you must be seeing the screen, and on the screen you are seeing that financial instruments is the heading on an Excel sheet. So this Excel sheet includes a briefing about the standard or the topic we are covering in the beginning. So you must be seeing some colored blocks. Now these are some concepts in the colored blocks which you are seeing right now on this sheet, and then after these blocks are gone, you will be seeing question number 1, Viking issues $100,000 5% loan notes. So what I will be doing, that I will be writing the answers on these Excel sheet only, right? So if you people want, so for practice purposes, you can use your notebooks or some rough paper sheets to write the answers and your calculators together so that you can learn in a much better way with me, right? So let's first start with financial instruments. 3 standards are covered in this syllabus on financial instruments, and those 3 standards are, one of them is IFRS 9, the other one is IFRS 7, and the third one is IS 32. So the topics we are going to cover are being taken from these 3 standards. Now let's start with the definition of the financial instrument, that what a financial instrument is. So what a financial instrument is, so financial instrument is a contract. So if you note in the golden block, you will see that it is a contract that gives rise to both a financial asset for one party and a financial liability for another party, or maybe an equity instrument for another party, right? So this is a necessity, that the contract should give rise to a financial asset for one party and financial liability or equity instrument for another party. Now I've given a basic example, a very basic example down. So you can see that usually some people purchase goods on credit, right? So there is a credit agreement in the sale agreement. So there is a contract between two parties regarding the credit. So for one party, the seller will be recording a receivable, and that receivable is a financial asset. And the other party, the buyer will be recording it as a payable, right? And therefore it will be a financial liability. So what happens, that the contract results in a financial instrument because it is giving rise to a financial asset for the seller and a financial liability for the buyer. So this is a very basic contract and the definition of the financial instrument. Now let's talk a bit about the financial asset and financial liability. So let's move on to the financial asset and financial liability, and then we'll start doing the practice questions on this topic. So students, what is a financial asset? So financial asset includes, 1, cash. It includes cash. Second, it includes investments in equity instruments, like if you buy shares in another company, ordinary shares of another company, so that's investment in equity instruments. Then the financial asset also includes contractual right to receive cash, like the receivable or another financial instrument from another entity, or a contractual right to exchange a financial asset. But the important thing is that the condition should be favorable for the party, then it is a financial asset. If the exchange results in adverse conditions or unfavorable conditions, then in that case it will be a financial liability, right? So some of the examples of financial assets are as follows. You can note some examples. It includes local currency, foreign currency. These are examples of cash. Bank balance in saving or current account, term deposits in a bank, investment in ordinary shares, investment in loan notes, investment in certificate of deposit, investment in redeemable preference shares, and accounts receivable, as discussed earlier, right? So this is about the financial assets. Now let's move on to the financial liabilities. Okay, so what is the financial liability? Financial liability is a contractual obligation to deliver cash or another financial asset to another entity, but the important thing is that the conditions are not favorable, like you are paying cash. So paying cash to another party delivering is not favorable, right? And in the same way, exchange a financial asset or a liability in conditions that are not favorable will be a financial liability. Now, some of the examples of financial liabilities include customer cash deposit, bank overdraft, customers cash deposit by a bank. So customers deposit held by a bank is a liability for the bank, financial liability for the bank. Bank overdrafts, then TFCs or term finance certificates. TFC stands for term finance certificates. Or loan notes issued, redeemable preference shares issued, payable to supplier on credit, and the interest payable. These are all examples of financial liabilities. So students, this was a briefing on what are financial instruments, what are financial assets and financial liabilities, and one more financial instrument is equity instruments. Let's look at the definition of equity instruments as well. So next, in the purple block, you will see the definition of equity instrument. So equity instrument is also a contract that evidence a residual interest in the assets of an entity after deducting all of its liabilities. And you can say that assets minus all liabilities is the residue, the leftover, the remaining portion, right? So a contract that entitles the party to the contract to receive the residual amount, and assets minus liabilities, is known as an equity instrument. And the most common example is an ordinary share, which you know. So this was all about the financial instruments, briefing about financial instruments. Now, how will we account for the financial instruments? This we will cover in the upcoming questions, the practice questions. So let's start with the practice questions so that we come to know the accounting for financial instruments. So let's start, students, with the practice questions. So this is the first question coming on your screen. You people are shared some handouts for the day one, and these questions on your coming on your screen are the same questions that are present in your handouts, right? So let's start with the question 1. So what the question 1 says is that Viking issues $100,000 5% loan notes. Now Viking is issuing loan notes of 100,000 means that Viking is giving up the loan notes to creditors and receiving money from them. So Viking is borrowing basically. So this is about liability. So loan note is the contract. Loan note is a contract between the creditor and the debtor, and Viking is the borrowing party, right? So Viking will be recognizing a liability in its books. And now it says that incurring issue cost of 3,000. So the first point over here is at what amount Viking will record the liability. This is the first point, that at what amount that Viking will recognize the liability initially. So Viking shall record the financial liability initially on 1st of January at the net cash received. So remember, participants, that the financial liability in case of a loan note will be recognized at the amount of net cash received by the issuing party. So how much cash has Viking received? This is what we need to know, net of issue cost. So Viking's loan notes par value or face value is $100,000, and the issue cost being paid by Viking is 3,000. So after paying these 3,000 issue cost, Viking is left with net cash received, which is 97,000. So this is the amount at which the liability will be initially recognized, and this instrument, this financial liability, is being recognized at amortized cost, right? So if a party issues a loan notes with an intention to hold the loan note until the end of its maturity, right, period, so the loan note will be recognized using the financial liability at amortized cost method, right? In this case, when it intends to hold till the end of maturity and will be just exposed to the contractual cash flows which are covered in the agreement, means the interest and the redemption amount which the Viking will be paying. So this is the amount 97,000 at which Viking will recognize its liability in 2004, 1st January 2004. So it recognizes at 97,000. So this is the balance outstanding in the books of Viking. Now, the second important point, interest expense will always be recognized at effective rate of interest and will be applied to the balance outstanding. So the next thing is interest expense. What will be the interest expense for 2004, which we are going to calculate? So what important point you need to remember is that the interest expense in this case is 8%. You will apply 8% to 97,000 in order to arrive at the interest expense. This is an important thing. Now see, you are having two types of interest in this question. One of them is 8% and the other one is 5%. Now at what rate to recognize the interest? This is what the rate at which you will be recognizing interest, and this is the effective rate of interest. Effective rate of interest means the rate with the creditor intends to receive from you and the rate at which the company is bearing the cost. And 5% is known as the stated rate of interest. This is known as stated rate of interest, right? And this is the rate at which the cash flow will occur. The interest payment will occur at this rate, but the interest expense will be recognized at 8%, right? So students, let's move ahead. Now what happens, that interest expense and the interest liability for Viking for the year 2004 is 7760, which is 8% of 97,000. Now the payment amount, the payment of interest during the year, this will always be applied to the face value. So face value of the bond is 100,000 and the stated rate will be multiplied with the face value to arrive at the amount that will be paid by Viking during 2004. So let's multiply the 5% rate with 100,000 in order to arrive at 5,000. This is what being paid by Viking during the year. Now what happens, that as the effective rate of interest is higher than the rate being paid by Viking, the balance outstanding will keep growing. So Viking was bound to pay 7760 to its creditor, but it did pay only 5,000 to the creditors. So the balance shall grow by 2,760. So now what will be the balance outstanding by the end of the reporting period? So balance outstanding at the end of the reporting period will be 97,000 plus 7,760, which was the interest amount calculated at effective rate, and Viking did pay 5,000. So the amount of the balance outstanding by the end of the reporting period 2004 will be 99760. Now, what the question requires from you? What's the question asking from you? The question is asking for the finance cost to be shown in the profit or loss account for the year 2005, not 2004. So first of all, what I did, I recorded the liability, and that on 97,000 I applied the effective rate to arrive at the interest expense, and then I deducted the amount which is paid by Viking. The balance grows to 99,760. So in 2005, the balance outstanding is not 97,000 anymore. Now it has grown. It has grown to 99,760. So now in 2005, the interest expense should be applied to 99,760. So I will apply the 8% rate to 99,760, which gives me approximately 7981. So the correct answer to this question is 7981. So option B is the correct answer to this question. The finance cost to be reported in the profit and loss account for the year 2005. Now, students, some points which I want to reiterate before I move on to the next question. So I'll be giving you the tips, some tips also, some good tips also. So what happens that interest expense, you have to remember these points which I am mentioning down here, that interest expense is always equal to these are the points that are most important in this question. The interest expense is always equals to the balance outstanding multiplied by the effective rate of interest. Right? And the interest payment will be equal to the face value of the loan multiplied by the stated rate. Right? So the interest expense calculated by me is using this formula: balance outstanding into the effective rate, and the interest payment has been recognized over here using face value of the loan note, which was 100,000, and the stated rate, which was 5%. So this is the point that you should remember in this question. In order to calculate the interest correctly, interest expense has nothing to do with the face value. We need to know that what amount is outstanding, and the amount of net cash received is the balance outstanding on which you have to recognize the interest. Right? So that's the conclusion point over here. So I am coloring the main points on the sheet. So the green block includes the points you have to remember. Okay, students, let's move on to the next question. Question number 2. Now, this question is on convertible bonds. Now, convertible bond is a hybrid. It's a mixture of equity and a debt instrument. So, the entity issues 3,000 convertible bonds at the start of year 1 at par or the face value, and they have a 3 years term and a fair value and the face value of 1,000 per bond. Interest is payable annually in arrears at 7% per annum. So this amount is the stated rate of interest. This 7% is the stated rate of interest. Each bond is convertible at any time up to maturity into 250 common shares. This is the conversion ratio. And when the bonds are issued, the prevailing market interest rate for the similar debt without conversion option is 9%. So this is the effective rate. This is the rate at which we will calculate the interest expense on this bond. And this one is the stated rate. Okay, students. So what the question asks, the question is asking how is this initially recorded? Between the debt and the equity elements. So when accounting for convertible bonds in the books of the issuer, the party who issues the convertible bond, in his box or in its box, we will recognize two items. We will recognize liability and equity both. So we need to know that how much of the cash received is a liability and how much of the cash received is the equity. So what happened that the company receives cash which is equal to 3,000 bonds into 1,000, out of which we need to allocate that how much is equity and how much is the debt component, the liability component. So first we will separate the equity and the liability component at which the liability and equity will be recognized. So step 1 is allocating the cash received by issuing the convertible bond into the debt component or the liability component and the equity component. So what we need to remember is when a convertible bond is issued, we have to recognize two things. We have to recognize debt component and the liability component, both. Yani bank debit, liability and equity, two credits. So first of all, we need to know, okay, what will be the liability and what will be the equity. So in order to know this, first we have to calculate the present value of the cash flows associated with the convertible bond Now, in case of a convertible bond, the bond may get converted into shares, but when calculating the debt and equity component, we will ignore that factor, right? So first of all, in order to know the liability and the debt component, we will just assume that suppose that the bond will be redeemed in cash. So if the bond is redeemed in cash, it is a 3-year bond. So the cash flows will occur for 3 years. And the amount of cash flows will be by cash flows we mean the contracted cash flows which the issuer will pay to its creditor. So it will include the interest payments, and the interest payments are calculated as I said before, the face value into the stated rate. So this is face value into the stated rate. So what is the face value of the bond? Face value was 3,000 bonds multiplied by 1,000. So this was the face value, 3 million, and the interest payment amount will be calculated on the face value, which is 3 million, multiplied by the stated rate. So the stated rate is 7%. We multiply by 7%, which makes 210,000. So this is the calculation of the interest payment. So in the first year, the issuer will be paying 210,000. In the second year, it will be paying 210,000. And the third year, along with the interest, it will repay the principal amount as well. So the repayment is also occurring at the face value. So in the second year, 3,210,000 will be the payment amount, right? And the 3,210,000 includes the face value at which the bond will be repaid and the third year's interest. It's a combination of these two amounts, right? This is the cash flow. Now, what we are going to do, we want to calculate the present value. So we will multiply the cash flow amount with the present value fraction, which has been given in the question. So as you can see, the present value fractions given in the question. So there are two present value fractions given in the question. So remember, always use the effective rate to calculate the present value. Never to use the stated rate to calculate the present value, right? So when calculating present value, when determining the liability amount and the equity amount of the convertible bond, we will be using the effective rate, right? Okay. So the present value fractions are 0.91, 0.83, and 0.766. These are the present value fractions, and in order to arrive at the present value, we'll multiply 210,000 multiplied by 0.91. Then 210,000 the year 2 multiplied by the second year's present value fraction, and the third year 3.21 million multiplied by 0.766. So this gives you this amount. Now the sum of all these three items will give you the liability component. So here you arrive at the liability component. Okay. So this is your liability component, In this question, the fraction has been rounded off. So if we take it up to 3 places, your answer will match with exactly with the amount given in the options. Right now, our answer is closer to the option B. The liability component is very close to the option B, right? Then this is the liability component, the debt component. Now the cash received. Now what happens that the company issuing the convertible bond received 3 million. Now there is a question. If the company is receiving 3 million, but the liability is 2,824,000, then what's the rest amount? So why is the creditor paying more? So it is paying due to the need to receive shares in the future. So he's paying for the shares in the future. So this amount, the remaining amount means cash received minus the liability component will be recognized as equity. So 3 million minus this gives you 175,740. So this is closer to this amount. Okay, so the correct answer is B. See, students, if I take the fraction till 3 decimal places like 0.914, the present value fraction is 0.914, the second year's present value fraction 0.837, and then 0.766. You will see that the amounts exactly match with the answer, isn't it? So in order to be more accurate, I have increased the fraction, right? Actually, student, if there is a box, they will give you the accurate fractions. They won't give you more rounded off fractions, right? And the answers in the box are expected to be in a range, right? So obviously there can be some difference of around $100 to $200 or $500 in which the answer will be expected, right? So don't worry, if there is a little bit difference in your answer, you won't be marked wrong, right? So the answer is in a range which is expected from you. So the box won't mark your answer wrong if you are just $1 or $2 away from your answer, but you're doing it correctly, right? So is your question answered? Okay. Okay, students. So the correct answer to this question Okay, students. So let's move on to the next question. The correct answer is option B to this question. Question number 3. Okay, students, I have received a few questions what if the question is in box? So let me answer it again, that if the question is in box, they will give you the exact fraction, right? And secondly, even if the question is in box and your answer is $1 or $2 different, yeah, $100 different from the answer, which is the exact one, right? So you are marked correct because the answer that is accepted by the computer, it is in a range, right? So they put in a range that any answers between suppose 20,000 and 20,100 will be correct. So if your answer is 20,066, you will be marked correct, right? So it's not very accurate over there, even in the box, right? So you don't need to worry much about it. So students, let's move on to the next question, question number 3. This question covers for a debt investment. Now we are talking about financial asset, right? That the investor is buying a loan note. Earlier we were talking about the company was issuing a loan note. Now this time he's buying, the investor is buying the loan. So debt investment under amortized cost, it must pass 2 tests. One of these is the contractual cash flow characteristic test, right? What is the second one? The correct answer to this is it is a business model test. So 2 tests are to be passed. One of them is the contractual cash flow test, and the second one is the business model test, right? So the correct answer to this question is A. Right? Okay. Students, please give me 1 minute. I'm muting the voice for a minute. Then I'll continue again. Till then, you can read the question number 4. Okay, students, my voice is back. So the next question is regarding what is the default classification for an equity instrument, for an equity investment. So if you are buying a share, what will be the default classification? So there are 2 classifications in which an equity investment can be recognized: financial asset at fair value through profit and loss, and financial asset at fair value through other comprehensive income. But what is the default category? The default category is fair value through profit or loss. So the correct answer to this is fair value through profit or loss. Now I'll show you a table in which the concept is given that what the categories are and how do we decide regarding these items. First, let me write the answer and then we continue. The correct answer is A, fair value through profit and loss account. So remember that if you buy an equity instrument, the board of directors or the party in the company or the group in the company or the authorized people in the company have to make an irrevocable election. They have to first make a document and authorize that this investment will be carried at fair value through other comprehensive income. Without making that election or without that authorization, you cannot recognize the financial asset or the equity investment at fair value through other comprehensive income, right? So the default, if you don't make an irrevocable election, then you recognize it as fair value through profit and loss account. Let me show you a small table regarding this. See, over here, you could see a small diagram which shows you classification of two financial assets and financial liabilities, right? So financial liabilities are categorized into three classifications: financial asset at fair value through profit and loss and financial asset at fair value through OCI. Equity investment will never fall under financial asset at amortized cost, right? It will either fall under this one. I'm making the block. Equity investment will always fall under either financial asset at fair value through profit and loss and financial asset at fair value through OCI. Now, in order to recognize the financial asset at fair value through OCI, you need to make an irrevocable election. Otherwise, you cannot record, right? And if you do not make an irrevocable election, then the default classification is financial asset at fair value through profit and loss account. Okay, so that's the answer to this question. So students, let's have a break for prayers for 10 minutes, so in which you can offer your prayers. So we will meet back in 10 minutes time. Is it okay? So I'm muting my voice for 10 minutes and then I'll see you back in 10 minutes time. So see you students in 10 minutes time. I'll be back in 10 minutes time. Okay. Welcome back, students. I'm back. Let's move ahead. Let me recall a point which I told you before the break, and that was that the items, these two categories, financial asset at fair value through profit and loss and financial asset at fair value through OCI, these both can be used for equity investments. The amortized costs category cannot be used for equity investments, right? Because for using this category, amortized cost category, you have to hold the instrument till redemption, and you all know that ordinary shares for equity investment are irredeemable, so their redemption time is not certain, so equity investment would never fall under financial asset at amortized cost, right? Okay, let's move ahead, students, to question number 5. So question number 5 is appearing in front of you now. So DEF purchased 15,000 shares in KMH company on 1st of August 2006 at cost of 6.5 each, and the transaction cost on the purchase amounted to 1,500. At the year end 30th September 2006, these shares are now worth $7.75 each. Right? Select the correct gain and the place it will be recorded. Where will the gain will be recognized, and what is the correct gain amount? So which one is correct out of these two? So let's calculate the gain first. So the fair value on purchase of the instrument, the equity instrument, was 6.5 multiplied by 15,000 shares that were purchased. This gives you 97,500, and then the fair value on the reporting date. So the fair value on the reporting date is 7.75, right, multiplied by 15,000 shares. So this makes 116,250. The difference between the values on purchase and on the reporting date is 18,750, right? So the correct answer is 18,750. You will select this. And where will this gain be recognized? So it will be recognized in statement of profit and loss. Why? Why in profit and loss? The reason is that the irrevocable election has not been taken place. The question do not talk about that any irrevocable election has been taken place regarding the equity investment. So the default classification is financial asset at fair value through profit and loss account. Therefore, the gain goes to the profit and loss statement. Now, one more thing, the transaction cost. So when the investment is in financial asset at fair value through profit and loss account, the transaction costs are recognized in profit and loss account immediately. So these are not included in the investment amount. This will be charged immediately to profit and loss account as expense when the transaction cost is incurred, right? So therefore I have not considered this 1500. But if the investment is in a financial asset at fair value through OCI or a financial asset at amortized cost, in that case you will add transaction cost to the investment amount. You can capitalize the transaction cost in other two investment cases, right? But you cannot capitalize in case of financial asset at fair value through profit and loss account. I'll be showing you a diagram ahead in a few minutes regarding the accounting for the transaction cost, that in which cases you can add to the investment and in which case you cannot, right? So in this case, as the investment is in financial asset at fair value through profit and loss, I have not included the transaction cost in the investment. Okay, so the correct answer to this question was 18,750. Okay, students, let's move on to the question number 6. Now, for each of the financial instruments below, match them to the appropriate accounting treatment. So you have to match to the appropriate accounting treatment. So let's match it. Convertible loan notes. So for convertible loan notes, we use split accounting, as we splitted the cash raised into equity and debt instrument, right? Then equity investment, where the entity has an intention to hold long term and has chosen to apply the alternative treatment. Alternative means they have selected or they have made an irrevocable election. So in case they have made an irrevocable election, then the investment will be carried at fair value through other comprehensive income, right? Then financial liability not held for trading. So there are just two categories of financial liabilities, right? One is carried at profit and at fair value through profit and loss account, and the other one is at amortized cost. So if it is not held for trading, then obviously it will be carried at amortized cost. So there are only two categories, either at fair value or and if it is held for trading, then it will be carried at fair value. And if it is not held for trading, it will be carried at amortized cost. And that equity investments, default position. So as discussed earlier, the default position is financial asset at fair value through profit and loss. So that's the accounting. Okay, this students, this Excel sheet will be available to you for your further revision, and inshallah you will get it tomorrow on the next class. So for liability also, I have a diagram about. Let me share the diagram with you regarding the rule. See, so there's a diagram for the classification of liabilities. So the liabilities are categorized into two classes. One is financial liability at fair value through profit and loss, and the other one is at amortized cost. So if it is not held for trading, then it will be recognized as amortized cost. Okay, so let's move ahead. So next is question number 7 to 11. This is a case type question. Let's attempt this case type question. So students, please go through it. First, I'm giving you a couple of minutes to read this question. Then we'll start. Okay, students. So the first case, the first paragraph covers factoring arrangement. The second case covers sale and repurchase agreements, and the third case covers convertible loan notes. So we have already discussed the convertible loan notes, but now we are going to discuss the factoring arrangement and the sale and repurchase. Right? So let's move on to the questions, and along with the question we will have a discussion on factoring, sale and repurchase, and convertible loan notes. Right? These three items are covered in this question. So the first question is question number 7. Let's discuss question 7. Which of the following is correct regarding Laid Law's factoring of trade receivables? So the correct answer from this is question number 7's correct answer is D. D is the correct answer. Now, how D is the correct answer? Let's discuss it. So what would the question say? That the company has sold his receivable. So receivable is an asset. So they have sold the receivable to a party, would be the buyer, and then there is an option that that party, if unable to collect money from the customer, it will return the receivable back. So what do we mean by this? That the company who has sold the receivable has received cash initially, right, from the buyer. And when the time period is over, the time period for financing is over, the other party says that please give back my money, right? So if the creditor manages to receive from the customer, in that case, he will not ask for the money. But if he fails, the creditor fails, the buyer fails to receive money from the customer, he will ask for the money from the seller, the laidlaw. So this is, if you repay the money back, it's not a sale. If you repay the money back, it's a loan. In case of loan, you repay the money back. So this is a with recourse factor. In case of a with recourse factor, if the factor fails to collect money from the customer, the factor will receive a return from you, right? So returning the money means that you have borrowed the money from them. So this is not a sale of receivable. You cannot credit the sale. This is a loan. So therefore, we have treated this as a liability. So treated as a loan. So 1.8 million has been treated as a liability. Now, I made a diagram to explain the both cases of factoring with recourse and without recourse. So let's go through the diagram to revise the types of factoring, right? So students, let's look at the diagram. Now what happens that a seller of goods and services sells goods on credit to the buyer and he records the receivable. Now what happens? He needs money. The seller of goods needs money. So the seller of goods delegates the authority to collect the money and sells the receivable to the factor company and receives the money in advance. So instead of after 3 or 2 months time, it receives immediately the cash. Now this factoring company will collect the money from the buyer. So collection of money then becomes the responsibility of the factor in the factoring arrangement. Now there are two types of factor. One is factoring with recourse. Factoring with recourse means that if the factor fails to collect money, he will take the money advanced back from the seller of the goods. And in case of factoring without recourse, once the factor pays money to the seller, he cannot receive the money back. What do this mean? This means that in case of without recourse, the factor cannot receive the money back. So this is a sale of receivable. In this case, we will debit the bank and credit the receivable. So receivable is sold. But in this case, it's not a sale, it's a loan. So in question 7, they have covered this one, the with recourse factor. So if you find that the factor will have to return the money, a factor will take the money back from the seller if the factor fails to receive money from the customer. It means that he's not bearing the risk connected to the receivable. So if it's not bearing the risk, sale cannot be recognized by the seller, right? And in case of without recourse factor, the bad debts are to be borne by the factor, and obviously the delays are also to be borne by the factor himself. So in that case, that's a sale because he accepts the risk. So the substance of this transaction is accounted for as under. So below there is one more diagram where you can see the accounting treatment of both these factors, factoring arrangements. So let's move on to the diagram. The substance of the transaction. Students, please go through this these two accounting treatments. So what does it say? That if the factor is with recourse means the factor can demand the money back which has been advanced to the seller. The factor extends the advance, means provides financing to the seller against the invoice pledged as security, right? So he takes invoice as security and lends the money. So the risk and reward connected to the receivable remain with the seller of the goods. So the receivable is not sold. So therefore the receivable shall be reported in the financials as it is, and the seller will recognize the advance received as a financial liability. So this was what required in question number 7. In the other case, what happens that the factor accepts the risk of bad debts, and in that case receivable shall not be reported. So in this case the company will not show the receivable in the financial statements in case of factoring without recourse. Okay, so let's move ahead. So you can see the entries as well down here. You'll be able to see the entries. So what happens that in case of without recourse and with recourse, these will be the entries. So let's look at the entry in case of with recourse factor. In case of with recourse, what happens? Bank debit and loan from factor credit. And in case of without recourse, the receivable is sold. So receivable is credited, bank debit, and the factor charges some administration cost, some insurance charges. So expense debit. So this is what the accounting for without recourse factor. Okay, so students, this was a brief revision of both types of factors, accounting for both type of factors. Let's move ahead. So now again, what amount should be recorded in equity to the nearest thousand in respect to the convertible loan notes issued by Laidlaw? So let's calculate the equity component in the same way as we did above. So first we will calculate the present value. The present value will give you the liability component. So there are 3 years. This is a 3-year arrangement. And the cash flow amount is 500,000. And on redemption, 10.5 million will be returned back. 10,500. Right? And then this is in thousands. And then the interest payment will be, and the redemption amount will be discounted. We will calculate the present value at every time at effective rate. Please do not forget that the present value will always be calculated effective rate and not at the stated rate. So we'll take the present value fraction at the effective rate given in the question, which is 8%, and the present value fractions given are 0.93, 0.86, and 0.79. This gives you the present value calculated at the effective rate. So 500 multiplied by 0.93, then 500 multiplied by 0.86, and then 10,500 multiplied by 0.79. Now this gives you the liability component. Which is 9190. Now this is the liability component. And the cash raised was 10 million, the face value. So in the end, you get the equity component. The difference between the cash raised and the liability component is the equity component, the amount given for that conversion rights by the creditor. So the answer to this is 810,000. Okay, students. So I'm waiting for a minute for you to copy if you need to copy. Then I'll move ahead to the question number 9. Okay, students, let's move on question number 9. Which two of the following items should be recorded in late loss financial statements for the year ending 30th September 2003 in respect of maturing inventory sale? Now remember, this maturing inventory sale is sale and repurchase agreement. This is a sale and repurchase agreement. So now the point to remember here is, in case of sale and repurchase agreement, always watch in the question that whether the repurchase price has been fixed or not, right? So you need to watch for the fixation of the repurchase price. So if the repurchase price is fixed, then the agreement is a loan agreement. Right? So what happens in a loan agreement, that first we receive some money from the creditor and we return the money which has been agreed in advance, that this much amount will pay you back along with the interest. So the cash will be paying back will be fixed in advance, right? So this is what to be considered as a loan. And what happens in a sale, that once we sell it, right, then if it's a sale and risk and reward passes on to the buyer, then the gains and losses all belong to him, right? So once we sell him, he enjoys the gain, the buyer enjoys the gain, and he bears the loss. So if we want to purchase back from him, then we'll be purchasing at the market price, which can be anything. It cannot be fixed, right? Only then we can transfer the risk and reward to the buyer. Otherwise, if we fix something that will be receiving this much amount, or suppose a fixed amount as mentioned here. So in this case, if you see in the question, what happens? that after a period of 10 years time, Laidlaw can buy it back for 7.4 million. So Laidlaw receives 4.5 million right now. Sorry, 5 million right now, and it will pay back how much? 7.4. So the amount has been fixed in advance. So this is not a sale agreement, right? So suppose this is the financing agreement. So if the inventory is 11 million and Laidlaw buys it back at 7.4, so obviously the creditor will not be able to get the benefit of this 11 million. Who gets the benefit? Laidlaw gets it. So it means that risk and reward has not been transferred to the buyer, so there should be a loan arrangement. So this is a loan. One. And secondly, if Laidlaw records this as a loan, then it will record finance cost as well. So Laidlaw will record the interest expense as well. And the rule for interest expense is same. Effective rate to be applied to the balance outstanding. The same rule will be applied. So the important thing is to remember is you need to see whether the repurchase price has been fixed or not. So if the repurchase price has been fixed, then the agreement is a loan or a financing agreement, and the financial charges will also have to be recognized. So now what happens? The balance outstanding is 5 million, right? And the interest amount the finance cost is 5%. The effective rate is 5%. So 5 million multiplied by 5% rate, it's in fact 4%. The effective rate is 4%. Sorry, participants, it's 4%. So 5 million multiplied by 4% makes the amount in total 5.2 million. So the balance outstanding grows to 5.2 million. As no coupon payments takes place, so no payment till 10 years will take place as per question. So now what happens? That this is in dollars and million. So the correct answer to this is two items are correct. You have to select two items. So please do read the questions carefully, that what the question says. You have to select two items. So if you go through the options, the option A is correct. 200,000 financial charge, 0.2 million, and then the loan balance which is required on 30th September 2003 at the end of the reporting period, right? So 5.2 million. So this matches. So the correct options are A and D. That's the correct answer. Okay, students. So let's move ahead. The next question. So you have to remember this. This was the key point in recording sale and repurchase agreement. And over here, this was the key point. In case of factoring, how will you record the factoring arrangement? These were the key points in green. I'm shading the key points in green. Okay, let's move on to the question number 10. Which of the following statement regarding the convertible loan notes is not true? Be careful. What is not true? See, it says, the option D says that interest is recognized at 5%. Interest will not be recognized at 5%. It will be recognized at effective rate. Interest is always recognized at effective rate. So this one is not true. D is not true. Interest is always recognized at effective rate. Interest expense recognized in the profit and loss account is at effective rate. So this was what you had to remember. The correct answer is D. Okay, students, so let's move ahead. Question number 11. Okay, so applying the principle of split accounting to convertible loan notes is important to satisfy which of the following qualitative characteristics? It's simple. So the best answer here is A. Why do you split into equity and debt? So that nothing is misrepresented, faithful representation. So that you correctly report things, right? So faithful representation is the correct answer. So the correct answer to this is A. So that you honestly report the liabilities and equity. Next case study is 12 to 16. So students, please go through it. I'm giving you a 2 minutes time to read it. Then I'll scroll down. So students, three items have been covered over here. One of them is convertible loan notes. The second one is a normal straight loan, a simple loan note, and equity investment. So let's go to the question. So I'm moving towards question number 12 now. So this is a revision. This question is the revision of all of things we have already done. A further revision. Okay, which of the items included in the trial balance extract will be classified as financial instrument? Which of these are financial instruments in the trial balance? Convertible loan note will be financial asset for the buyer, and for the issuer it will be equity instrument and financial liability. So it is a contract which gives rise to financial asset for one party and financial asset and liability, equity and liability for another party. Loan note will be financial asset for the creditor, and for the other party it will be a financial liability. So this also is a financial instrument. And equity investment will be a financial asset for one party and equity instrument for another party. So in this case also, this is a financial. All of the three items are financial instruments. So the correct answer is all three items. All three are financial instruments. All of the three are contracts and giving rise to financial asset at one side, and at the other side either a liability or an equity instrument. Okay. So next, what should be the value of the liability element of the convertible loan note? Be at 30th September 2005 to the nearest 1000. So again, we get the same item. We have to calculate the present value in order to arrive at the answer. So let's calculate the liability component. So according to the question, effective rate of interest is 10%, at which we'll be calculating the present value. And the loan note is issued at par, 30 million. The payment amount will be 8% of 30 million. Now what happens that the directors, it says, okay, the director has correctly split the instrument into its equity and liability components. So you can see in the question that they have correctly, the director has correctly categorized the receipts into the liability and the equity component, right? So 28,508, this is the amount he has correctly calculated at the time when the convertible bond was issued. Now what happens? What you have to do, you have to add the financial charges to this at effective rate, and you have to deduct the payments which you have made as we record the liabilities. We will record the payment and will arrive at the carrying value, which will be reported in the financial statements on 30th September 2005. So let's add the finance cost and deduct the payment. So they have already calculated the liability component correctly, so no need to calculate the present values, right? But the effective rate is 10%, at which we will record the finance cost, and the payment will be calculated at 8% of what? 8% of face value. And the finance cost will be calculated at 10% of what? 28,508. Okay, let's do it. Question number 13. The balance outstanding on convertible debt account has been correctly recorded at 28,508. Now you have to add the finance cost at effective rate. So the finance cost at effective rate will be 28,508 multiplied by the effective rate, and the effective rate is 10%. So this makes 2850.8. So let's round it off. Okay, and then deduct the payment. And the payment, as I said earlier, that it will always be at the stated rate multiplied by the face value. So the face value was 30 million and multiplied by 8%, which was the stated rate. So this makes so the liability for interest is 2851 and the company makes a payment of 2400 only. So this results in 28,959. This is the correct answer. 28,959 is the option number C. Correct answer is option number C. $28,959,000. Okay, students. So let's move ahead to the next part. What finance cost should be shown in the profit and loss account in respect of the loan notes? So the same rule, effective rate multiplied by the balance outstanding. So what happens in this case, that first we have to see what was the cash received. The face value of the loan note was $10 million. The answer is required in dollars. So I've taken it 10 million. Then deduct issue cost from it. The issue cost is 400,000, which should be deducted, and this gives you the net cash received. So the liability will always be recognized as net cash received when you are accounting for using the amortized cost method. So 9.6 million is the balance outstanding. This is supposed to be the balance outstanding, and the interest will be applied to this amount. So the financial charges, as I said, 9.6 million multiplied by the effective rate. So the effective rate of interest is 8%. This gives you 768,000, which is the correct answer. See, where they give a blank, usually the answers are in round figures, or they're not much tricky, like in decimals or fractions, right? So the correct answer is $768,000. But be careful that the answer here is not in thousands. It is just in dollars. It is not in millions. Otherwise, you have to be very careful. Very carefully, you have to convert it in millions or in thousands. So the correct answer is 768,000. Okay, next. Question number 15. What income should be recorded in the statement of profit and loss in relation to equity investments? So let me take you back to the question. So what do the questions say regarding the equity investment? It says that the equity investment related to 1 million shares in Kapoor, right? And they have received a dividend of 10 cents per share. So 1 million multiplied by 10 cents. So they have received a dividend of 1 million into 10 cents means 100,000 or 0.1 million, right? And the fair value of the Kapoor share is now $7, right? Earlier the value was initially the investment was recognized equity investment was at 6 million, means that this is in thousands. The share was of $6, but now it is of $7. So they have not made any irrevocable election. Therefore, the financial asset is being carried at fair value through profit and loss account. So all gains, all capital appreciations are going to the profit and loss account. And what about the dividends? Dividends also will be recognized in the profit and loss account. So please do not forget to record dividend as well as an income in the profit and loss account. So if you forget, your answer gets wrong. So what happens in the question number 15? First, we will record increase in fair value in profit and loss account. So the fair value increases. The share is now of $7. 1 million shares. Then dividend income is to be recognized. The dividend income is 1 million share multiplied by dividend paid at 10 cents. So 1 million is the income on the change in fair value, and 10 cents is the dividend income, which makes 100,000 or 0.1 million. So in total, the income to be recognized in the profit and loss account should be 1.1 million. So it's 1.1 million that should be recognized in the profit and loss account. The correct answer is B. So remember, if they say that what will be recognized in profit and loss, so all type of income should go, which with the business is earned in the profit and loss account. Otherwise, you will get the answer. See, they are giving an option 1 million as well. So if you forget to record the dividend in the profit and loss account, then your answer goes wrong. They have given that option one. That option D is wrong because it includes only the fair value change. So please read the question carefully. That you are considering all effects in the profit and loss. Okay, let's move on to 16. Question number 16. Now this question is on transaction cost, which I wanted to discuss, and that's the rule behind the transaction cost. Look, please look at this chart and then give the answer. This chart is very important. What happens? See, if the investment is at financial asset at fair value through OCI, where the transaction cost is going, include the transaction cost in cost of investment. You can include in cost of investment. And financial asset at amortized cost, in that case also, you can include the transaction cost in the cost of investment, or you can say you can capitalize it. But in case of financial asset at fair value through profit and loss account, in this case, you cannot capitalize. You have to recognize the transaction cost in the profit and loss account, as I said earlier. So it's only in case of financial asset at fair value through profit and loss that the transaction cost will be recognized in the profit and loss account. So the correct answer over here is only in this case, not capitalized. So that's the answers to these questions. So students, let's move on to the next question. So that's end of the financial instruments. Now we move on to IS 38. So the next is intangible assets, IS 38. This is question number 22, intangible assets. Some question in between, due to some clerical fault, were included here from 18 to 21, which belong to the non-current asset, the property, plant and equipment, which I will cover over there when I'll be covering IS 16 and IS 36, right? So let's move on to intangible assets, question number 22. Okay, please go through this question. Now with the help of this question, I will explain you a few concepts first, and then I'll move ahead. You can please read the question. Okay, the concept being covered in this question number 22 is of an internally generated intangible asset. Developing a new type of product. Developing a new product means we are making the or developing the intangible asset in-house. So in order to recognize the cost incurred on developing an intangible asset, all conditions should be met. What are the conditions? There should be a feasibility. The company should be having ability to complete the project and sell it or generate future revenues. The company shall be having resources to complete the project. Means they should be having cash. Now what do you see over there? They don't have cash on 30th September. When did they arrange the cash? They didn't have any probability of having cash on 30th September. That this means that on 30th September they were not certain that they will be able to have some resources which will help them complete the project and generate future revenue. So until and unless all conditions are met, there are 6 conditions: feasibility, second is ability to complete and sell, third is availability of resources, fourth is that they should have market, fifth is that they should measure the cost reliably, right? That how much expenditure has been incurred in order to develop the asset. So until and unless all the conditions are met, which I'll show you down in a minute. Look, let me show you the conditions mentioned in IS 38, the 6 conditions. So you can see the conditions, 6 conditions over here in the green box. Very important conditions. All of the conditions should be met. If any one of the conditions is not met, even if only one of the conditions out of these 6 are not met, you cannot capitalize the development cost. So all of these 6 conditions should be met. Now what condition is not present over here is availability of resources. So in this question, they do not have abundant resources to complete the project, right? So these are the 6 conditions: technical feasibility, intention to complete, ability to complete, existence of market, availability of resources, and cost can be measured reliably. So the correct answer is correct answer to question 22 is A. They've asked which one you cannot recognize as an asset. So on 30th September, the conditions, all conditions were not present. Okay. Okay, students, please go through this yellow box. Let me enlarge the font size so that you can see it clearly. So there are 4 ways in which you can obtain an intangible asset. This yellow block covers the 4 ways in which you can acquire an intangible asset. The 4 ways. The first of it is separately purchased. Separately purchased means you purchase the software, you purchase the product formulas from a ready-made formula from an outside company. So you can easily debit it at cost, right? No complications. You can debit at cost if you expect that future benefit will flow to the entity and the cost can be measured reliably and you can control it. So 3 conditions are there. You should be able to control it. You can measure the cost reliably, and third is future benefits are probable. Right? So next is, second way is acquired in a business combination. Means if you are buying a subsidiary, so all subsidiaries intangible assets which they have developed will be recognized in parent's financial statements. They will be consolidated, right? So it includes intangibles of subsidiary company. It includes brand of the subsidiary company. It includes customer list. All of these assets which belong to the subsidiary company, and they not be appearing in the financials of the subsidiary company, but they will be appearing in the financial statements consolidated, the parent company's financial statements. So they will be recognized at fair value. As in consolidation, we learn that subsidiaries, all assets of subsidiaries are consolidated at fair value. And if they are not at fair value, we bring them at fair value through fair value adjustment. So this was the second way. And the third way is self-generated intangible asset. So the 6 condition rule, which I showed you a few minutes ago, is for this category. The third category, self-generated intangible asset, that we suppose are a pharmaceutical company and we are developing an intangible asset. We are developing a formula for suppose coronavirus. So this is all about the self-generated intangible asset. In this case, until and unless we are in the development phase, first there is the research phase, then comes the development phase. I'll be showing you downwards that what happens in the third case. Let's see the rule, what they say about the third category. So what the IS say, just look at the diagrams. These diagrams will give you briefly explain you all the rules covered in the IS 38. Just look at this diagram, for which I'm making a block. See, 3 blocks you are looking at right now. So I'm highlighting the blocks. Please go through the rules in the detail when you get these sheets. See, first of all, always if you are developing an asset, you will be going through the research phase. Research means obtaining scientific or technical knowledge. Without that, you can't develop an asset. In that phase, all expenditure in this phase is charged to the profit and loss, and it cannot be reinstated. Even if afterwards the conditions are met, you cannot restate it. Once gone to the profit and loss account, then you cannot capitalize it in future when the conditions are met, right? So in research phase, all expense goes to the profit and loss account. And then comes the development phase. Development phase means you have obtained the appropriate information, and now you're designing, you're making molds, you're making dies, right? So you're designing the thing, you're making the tablet, first tablet. So expenditure, the development cost can be capitalized in the development phase. But when, the important thing is, if all the conditions are met, as I showed you, the feasibility, ability, intention, resources, market existence, and cost can be measured. Even one of the conditions is not met, you cannot capitalize it, right? And then what happens, that once you have capitalized the asset, then you will amortize it when the commercial production stage starts. Once you make the formula and start making the medicine, you start making the shoes, you start making the products, computers. So what happens, that all the development cost capitalized will be amortized, right, over its useful life, if the useful life can be estimated as finite. If you cannot estimate the useful life as finite, obviously you need a denominator to calculate the amortization. You won't be able to calculate the amortization over it, right? So this is the main rule for the third category, the self-generated asset. That research phase, all expenditure in profit and loss account. Development phase, you can capitalize, but once all the conditions are met, after that conditions meeting phase, then after that you can capitalize, right, until the commercial production begins or the development is over. Till that time you can capitalize the cost. And once the commercial production begins or the intangible asset is available for commercial production, you will start amortizing the development cost. So this is the 3-phase rule. for the self-generated intangible asset. Okay, let's go to the question. This was a brief rule. Very important area for the exam. So like financial instruments, financial instruments is very important. That's why I have covered it in the first phase on the first day, and plus some more items. So obviously, I'm covering and hitting the target, right? So I'm covering those items through which you can easily pass and get good marks, right? Students, let's move on to the next question. Question number 23. This is our next question. So please read the question, students. You have 2 minutes to decide the answer. Okay, students, in this case, the question asks for that which of the following could be classified as a development expenditure in M statement of financial position at 31st March 20 Y0. Item A cannot be capitalized. Why? Not viable. Not viable, therefore cannot be capitalized. Then second one covers what phase? Research. You cannot capitalize the expenditure in the research phase. And the third case, it is future benefits are not expected. They are expecting a loss. Means they won't be able to recover the cost. So they cannot recognize an asset when benefits are not probable in future. So in this case, also they cannot capitalize. So which one is left? Over here they say that the packaging is expected to reduce M's distribution cost by 35,000. So every year this development will save 35,000. So it is producing savings for the company. So this one can be capitalized. So it's not necessary that the benefit will flow in the form of cash receipts. It is not necessary. Benefit can also flow to the company in the form of cost savings. Like, for example, if you make a solar plant or solar energy, you start using solar energy to produce, so you'll be saving fuel. So even if you start saving fuel, you are saving some money. So you are benefiting future benefits. It's not necessary that you sell something and only then if you generate revenue, you will be capitalizing the cost. So you can also capitalize when you are saving expenses. Yeah, you are being able to reduce your expenses due to due to the development. So the correct answer to this question is D. That's the correct answer. Now let's move on to the next question. Question number 24. Now this is a good one. So what they say, let me cover the important points, that they spent 7,50,000, right? And up to this amount was spent up to 30th of April 2005. Beginning from they say in the year ended 30th June 2005. This means that they started the project on 1st July 2004, right? During the year they say. So 1st July 2004 they start and they completed on 30th April. So this spending they are talking about has been incurred in how many months? 10 months. It makes 10 months. So they have spent 750,000 during this period of 10 months. Now what they say that the feasibility or the conditions were met on 1st of January 2005. So from the time when the conditions are met, only then you can capitalize, right? So the first 6 months expenditure shall be charged to the profit and loss account as an expense, as the conditions were not met. But after the conditions are met, from 1st January 2005, January, February, March, April, 4 months you can capitalize, right? So let's design the answer to this question. What happens first of all? That from July 2004 till 31st December 2004, record expense. This goes to profit and loss account as an expense, 75,000 into 6 months. Then from January 2005 to 30th April, 4 months, when the project is completed, means the commercial production would have started. So capitalize. You have capitalized 75,000 into 4 months. So this has been capitalized, and then amortization. Amortization expense, because your year end is 30th June, so 2 months amortization should be recognized. So amortization will be 3 lakh divided by the life, which is 5 years, multiplied by 2 divided by 12. This gives you the amortization for the month of May. In fact, they say the product produced by the project went on sale from 31st of May, 1 month amortization only. So only 1 month amortization will be charged, because after May you will be charging amortization as the revenue started generating on 31st of May. So only in June the benefit started flowing and the asset was available. So we will calculate amortization for 1 month's time. month of June. So if you calculate amortization for 1 month's time, this makes up to 5,000. So out of 3 lakh capitalized cost, we shall deduct 5,000 to arrive at 295,000. The correct answer is so they asked for, see what they asked for, the carrying amount. Carrying amount means cost minus accumulated depreciation in case of IAS 16. But in case of IAS 38, cost minus accumulated amortization. So amortization for 1 month's time was deducted when the asset was available for sale. So when the development is available for sale or is development for available for generating revenue, you can start amortizing it, right? Okay. So let's move on to the next question, students. Question 25. Now this one is similar to the above question, but over here they are asking what Dempsey will charge to the profit and loss for development cost. They are not asking for what to be recognized in the balance sheet. They are asking about what to be recognized in the profit and loss account. So let's make a working for this. So they say they were spending 40,000 per month. 40,000 per month was being spent until the project was completed on 30th June 2004, right? And they say Dempsey commenced the development stage of the new drug on 1st January 2004. 1st January there commenced the development stage. So since 1st January you can capitalize, and the project was completed. See, the directors became confident of the project's success on 1st March 2004. The project's feasibility was found on 1st March 2004. So since when you will start capitalizing? From March to June, and the rest of the expenditure should be charged to the profit and loss account. So what happens? So development phase started in January, but in January and February, the conditions for capitalization were not met. So for the both months, January and February, you cannot capitalize the expenditure. Even you are in the development phase, you cannot capitalize until conditions are met, right? So let me make a solution of this. In the month of January and February, 40,000 multiplied by 2. This goes to profit and loss account as expense. Conditions not met, right? Then from March to June, conditions are met. So they will capitalize 40,000 multiplied by 4. So there are 4 months, 160,000 capitalized. Now the year end is 30th September. As the year end is 30th September, 2004. You will have to amortize. After June, the project was completed and was available for you. So July, August, September, 3 months amortization should be deducted. So deduct 3 months amortization from it. And the life is 5 years. The development cost life is 5 years. Okay, I'm muting for a minute and I'll start again. So till then you can start calculating the amortization, please. Okay, students, I'm back. Okay, students, amortization calculate कर लेते हैं. So amortization will be calculated for 3 months time. So it's 160,000 divided by 5 years multiplied by 3 divided by 12. So now what they ask, this 8,000 is also going to go to the profit and loss account as an expense. So the total expense going to the profit and loss account is both the 8,000 one, the amortization, and the amortization for the 3 months time, July, August, and September. So except this capitalized amount, which have moved down towards right, the two items going to profit and loss is the 2 months expense, which will not be capitalized, and the amortization. So the total amount charged to profit and loss is 88,000. Right. So the correct answer is D. Okay, students, let's move on to the next question. So that's the end of IS 38. Now let's move on to the next standard, which is IS 33. So earnings per share is the next one. Let's start with the earnings per share standard. Okay, students, please read the question 26, and in 2 minutes time I'll be discussing the answer to this question. So we are first discussing the basic earnings per share. We are having two types of earnings per share. One is basic and the other one is diluted earnings per share. Right now we are doing the basic earnings per share. Okay, students, let's start this question. See, what happens that they say the important thing over here is they make a right issue, two right issue, one for two right issue. So they have issued one share to every shareholder who possess two shares. And what is the right issue? In right issue, the company issuing shares to existing shareholders at a price that is lower than the market price, the current market price. So what was the current market price of Garfish shares? It was $2, but the company issued at how much? 1.4. So there is a discount element in it. So instead of $2, the company has issued the share at $1.4. So now what happens? How will we adjust for the right issue? Just please note, first of all, we will calculate theoretical ex-right price. What will calculate? The theoretical ex-right price. So let's calculate the theoretical ex-right price first. So okay. Theoretical ex-right price. Now, what is the theoretical ex-right price? Theoretical ex-right price means the company is currently having some shares outstanding, right? The value of that plus the further cash which the company generates, right? Divided by the number of shares, all shares including the right shares issued. So this gives you a price of a share, a theoretical price of a share after the right issue. So what happened? Okay, the company was having two shares, or you can say an investor was having two shares, the market price of which was $2. So total value of those shares with that person was $4, right? Then he got one right share. He got one right share for how much? 1.4. So now the company received 1.4. So what happens? That the total value of both shares, the existing and the new one, the right share, becomes 5.4, right? And the number of shares, initially he was holding two shares, now he's holding three shares. So the value of three shares now is 5.4 million. So the theoretical ex-right price is TERP's theoretical ex-right price, 5.4 divided by 3. This makes 1.8. First step is calculating theoretical extra price. After calculating theoretical extra price, you will calculate an adjustment fraction. Calculate an adjustment fraction. Adjustment fraction is come right price. Come right price is the price immediately before the right issue, and the come right price was $2 divided by theoretical extra right price. So 2 divided by 1.8. This gives you the adjustment fraction, right? And now this is the adjustment fraction. What we are going to do with this, I will tell you in the next step, right? So now start calculating weighted average number of shares. Right? So weighted average number of shares will be, the company was having 2.4 million ordinary shares on 1st of January 20x7. 2.4 million ordinary shares were there. Okay. And these shares were held by the company from 1st January till the right issue occurred. Right? Now the right issue occurs on 1st of April. Means after 3 months time the right issue occurs. So until 3 months the company was having 2.4 million shares. So we will take a time fraction. So time fraction is 3 by 12. Right? So what we'll do, we will first see that since beginning of the year till what date the shares change, the number of shares change. So the change in share occurred on 1st April. So first I took 2.4 million shares at the beginning and the time till the shares change. The shares changed on 1st April. So I've taken a time fraction of 3 upon 12, right? Now we will also put an adjustment fraction over here. So adjustment fraction will be applied to all shares that were outstanding prior to the right issue, right? Adjustment fraction will be applied to all shares outstanding prior to the right issue. So adjustment fraction is 2 divided by 1.8. This will be applied over here because till now right issue has not occurred. So we have applied to it. So you get, now multiply all these three. So 2.4 multiplied by 3 divided by 12 multiplied by 2 divided by 1.8. You get this much shares. Now what happens? 1st April comes around. Now on 1st April, the company which was having 2.4 million shares, it issued 1 share for every 2 existing shares. So there occurred a right issue. The right issue shares were 2.4 divided by 2, 1.2 million shares. Now the shares get 3.6 million on 1st of April 20x7. Until when will the shares outstanding will be 3.6 million? Till the end of the reporting period. Means on 31st December 20x7. So now the shares are outstanding for 9 months. So the total number of shares are now 3.6 million, right? And you will multiply it by 9 divided by 12. adjustment fraction is not applicable over here. Why? Because adjustment fraction will be applied to the shares outstanding prior to the right issue. So 1st April, the right issue occurred. So I have applied the adjustment fraction to only 3 months, the shares in the prior 3 months. Right? So there you go. You get 3.6 multiplied by 9 divided by 12, 2.7 million shares. So now you get the weighted average number of shares for the 12 months time. So the total of the weighted average number of shares is 3.3667. This is your weighted average number of shares. Now the earnings per share is, EPS is the profit net profit attributable to the ordinary shareholders divided by weighted average shares. This is the basic EPS. Right? So let's calculate it. The profit for the year was 3 million. So 3 million divided by 3. This gives you an EPS of 0.891. This means 89 cents. 89.1 cents. So this is the EPS. So remember this working, we will take the number of shares multiplied with the time fraction and multiplied with the adjustment fraction. Till when will you multiply with the adjustment fraction? Until the right issue has occurred. So the answer to this question is 89 point. And now they've given in cents, right? That's why I'm mentioning it in cents. Otherwise, if they've asked in dollars, but usually it is in cents. If they've asked in dollars, then you will put 0.89. Okay, so you can complete it. I'm waiting for a couple of minutes, and then I'll go to the next question. Question 27. Okay, students, now moving on to the next question, and the next question covers bonus issue. So same as with bonus issue. For bonus issue, we will also make an adjustment, and we will take an adjustment fraction, and that fraction will be applied to all shares outstanding before the bonus issue occurs. So let's see what the question says, that the company issued 1-for-3 bonus issue. It issued 1-for-3 bonus issue on 1st of June 2004, and the year end is 31st December. So they have issued the bonus shares after 6 months time. And then they issued 1 million ordinary shares at full market price. So there is no adjustment for the shares if they are issued at full market price. Only we adjust the weighted average share working when there is a right issue or bonus issue, because we are collecting less money only. If we are giving discount, only then we will adjust the weighted average working. Otherwise, we do not adjust the weighted average working. Okay, so let's start doing this question, students. First of all, okay, now let's start. The year begins on 1st of January 2004, and the company had 3 million shares. So from 1st of January till 30th of June, the ordinary shares were 3 million, and the time fraction is 6/12. Now we need to have an adjustment fraction over here for bonus issue. So what will be the adjustment fraction for bonus issue? Let's calculate that. So adjustment fraction for bonus issue is equal to shares after the bonus issue divided by the shares before bonus issue. So that's the adjustment fraction. So what happened over here in this case, that 1/3 bonus issue has occurred, right? So existing shares were 3, and then the company issued a bonus for every 3 shares. So 1 share was added. Due to addition of this share, this bonus share, the investor having 3 shares was now having 4 shares. So the bonus fraction is equal to 4 divided by 3. This is the bonus fraction. And again, this will be applied until the bonus shares are issued. So from 1st January to 30th June, bonus was not issued. So we'll apply the bonus fraction, which is 4 divided by 3. So this gives you 3 million multiplied by 6 divided by 12 into 4 divided by 3. Then what happens? The bonus shares were issued, and the bonus issue takes place on 1st of June. Sorry, 1st of July, in fact. Okay, 1st of June. So I will take a time fraction 5 months over here. Sorry. So if the bonus is issued for on 1st of June, then we'll be taking 5 months time, from 1st January till 31st of May. Right? So time fraction is 5 months, and now the company issues 1 bonus share for every 3 shares that were existing. So what happens that 1 million more shares has been issued. And now the total shares sum up to 4 million shares. Until when will these 4 million shares will remain? Till the next issue takes place. So they also make another issue, a full price issue, on 30th of September. See, they have made a full price issue on 30th of September. On 30th September 2004, SAM company issued a further 1 million shares, but at full market price. So after this, after these 4 million shares, which remain outstanding till 30th September, means July, August, and September. So this makes June, July, August, September. This makes 4 months. So 4 divided by 12. So these remained outstanding for 4 months. No adjustment fractions. After the bonus shares have been issued, after 1st June, there will be no adjustment fractions. Then full price issue. The full price issue was also of 1 million shares, and the total shares then summed up to 5 million shares. And these shares were outstanding since 1st of October till 31st of December. Means October, November, and December, 3 months time. So students, please check, always check that the total months in the time fraction column should make up to 12 months. Just add these months over here in the time fraction column. Always check. See, 5, okay, plus 4, 9 plus 3, 12 months. Because the EPS for 12 months, you should be having 12 months over here. So please do check. Okay, so now 5 million into 3 divided by 12. So this gives you the weighted average number of shares for the year. So 5.58. I need to make a correction in the first one for 5 months, right? So it makes 4.25 million shares. So that's the weighted average number of shares, and now we will calculate the EPS. So EPS for the year is the profit for the year divided by 2 million was the profit divided by the weighted average number of shares 4.25 million. So this gives an EPS of 47.1 cents. So students, that's all for now, for today. So the correct answer is option A. That's the correct answer. So students, I will be giving you this first day's work, not tomorrow, because tomorrow will be completed the first day's work. A few questions are left, around 12 questions for today's work are left. So we'll cover it tomorrow, right? And then I'll pass this sheet to you, right? So thank you very much, students, for attending the workshop, the ACCA's practice to pass, and being with me from so far away. So really nice to meet you and work with you people. So see you in the next session tomorrow.